Monetary policy is controlled by the central bank, and the main tool that they use is the adjustment of interest rates. And so that is the cost of borrowing and the return from saving money. The bank, or the base rate, is set by the Monetary Policy Committee at the Bank of England, and they meet every month to decide whether interest rates need to rise, fall, or stay the same. Another tool they have at their disposal is controlling the money supply, which they do primarily through buying and selling bonds. So when the bank pursues a policy of quantitative easing, it's sometimes referred to as printing money, but what really happens is the bank buys up large quantities of government bonds, which releases more money into the financial system and has a similar effect to cutting interest rates. Now, exchange rates come under the banner of monetary policy as well. So the exchange rate is the price of one currency in terms of another currency or set of currencies. But in the UK, we operate a floating exchange rate system, which means the price of the pound is left to be determined by market forces, and the bank doesn't tend to try and directly influence it as a monetary policy tool. Now, the main objective of UK monetary policy is to maintain price stability, and we have an inflation targeting system where the bank is supposed to use these tools to try and keep the rate of inflation at or around 2%. With interest rates being the main monetary policy lever to pull in influencing what happens in the economy, there are two main types of monetary policy, and they come about from either cutting or raising interest rates. So expansionary or inflationary monetary policy helps to try and increase aggregate demand by cutting interest rates. And the idea here is that you lower the cost of borrowing, and with cheaper access to credit, consumers are more able to borrow in order to fund their spending. And at the same time as this, businesses are finding cheaper loans, meaning they can more easily fund their investment projects. Now, on top of that, we've got individuals facing a choice of whether to put their money in the bank or to go out and spend it. And they'll be encouraged to spend by the lack of reward that lower interest rates gives them from money in the bank. And all of this works together to increase consumption and investment, which are components of aggregate demand. So aggregate demand grows and we have the curve shifting to the right. That helps to achieve the goal of expansionary monetary policy, which is to boost real GDP, increasing economic growth and providing more jobs as well. And that's exactly why, in response to the 2008 recession, interest rates dropped from 5% to 0.5% pretty much overnight. Now, the trade-off of these expansionary policies are that, as you can see on the graph, price level rises as a result. So you have to cope with the inflationary pressure that comes as a trade-off from boosting that real GDP. Now, contractionary monetary policy attempts to decrease aggregate demand by increasing interest rates. So it sets that whole process into reverse, and it's used when we're worried about rising inflation. So with contractionary monetary policy, it's going to increase the cost of borrowing, and therefore you discourage spending and investment. And it also increases that incentive to save and therefore reduces the incentive to spend. As a result of that, consumption and investment are likely to reduce and aggregate demand falls, meaning the curve shifts to the left. That helps keep inflation under control, but accepting there's going to be a trade-off there in terms of reduced growth and fewer jobs. So as we said earlier, the UK, like many countries, now operates a floating exchange rate system, meaning they leave market forces of supply and demand to determine the exchange rate of the pound rather than trying to artificially fix it at a set level. Having said this, as with so many of these things, they are heavily interlinked, and by changing interest rates, it will have an impact on the exchange rate, and that actually tends to reinforce the impact of expansionary or contractionary monetary policy on aggregate demand. So if we had a UK expansionary monetary policy of cutting interest rates, that would decrease demand for the pound. And that's because less return can be earned on money held in pounds in UK financial institutions, so fewer people are buying the pound. And lower demand for a currency will mean that it depreciates, just like lower demand for any product will put downward pressure on its price in product markets. And so we have a depreciation in the pound, and that would make UK exports cheaper and imports more expensive. And that means more demand for exports, less demand for imports. Net exports, exports minus imports, will therefore rise, and that's one of the components of aggregate demand. So aggregate demand increasing, the curve shifts to the right, and that supports the more direct effect of reducing interest rates as part of expansionary monetary policy, increasing consumption and investment. Now that whole thing is going to again work in reverse with increasing interest rates. This time, demand for the pound would increase, have an appreciation in the exchange rate, so price of exports would rise, price of imports would fall. Fewer people buying UK exports and more demand for imports means this time a reduction in net exports. And again, as a component of aggregate demand, this time the curve's going to shift to the left, supporting that contractionary monetary policy in controlling inflation.